In 2022 alone, hackers stole over $3 billion in crypto. And do you know how much of that was insured? 1%. And today we're finding out why, and how that's finally changing. Welcome back to Unwrapped, your deep dive into DeFi, NFTs, on-chain culture, and all things in the BMX ecosystem. And today we're tackling an elephant in the room, risk. We all know the stories. A protocol gets hacked, a smart contract fails, or an exchange collapses. In the traditional banking world, you have the FDIC. If the bank burns down, the government guarantees your money. But in crypto, historically, if you lost your funds, they were just gone. You were driving a sports car at 200 miles per hour without a seatbelt. But a new industry is emerging to build that seatbelt. From digital co-ops that vote on payouts to robotic policies that pay you in seconds. We're going to look at the safety nets being built right now. And as always, just a quick but important reminder, this is for educational purposes only. It is not financial advice. Part 1, the Wild West problem. To understand the solution, we first have to understand the problem. Why can't you just call up Geico and insure your Bitcoin?
Yeah, I'd like to insure my crypto. Please and thank you.
No, my brain is not smooth if you must know.
Well, it comes down to the nature of the risk. In crypto, we don't usually deal with physical bank robbers. We deal with smart contract failures. For the beginners, think of a smart contract as like a digital vending machine.
Need a drink.
You put a coin in, and it automatically gives you a soda. No shopkeeper required. It's all automated. But what if a hacker figures out that if they kick a machine in a specific spot, it spits out all the sodas for free? That would be a smart contract exploit. And in 2022, over $3 billion was lost to events like this. But only about $34 million was reimbursed. That's a massive gap. 99% of the market is flying unprotected. So how do we fix this? Part 2, the Village Co-op. The first major attempt to solve this came from a project called Nexus Mutual, the pioneer of the space. Think of Nexus Mutual like a small village pooling their money. In the old days, before big insurance companies, if a farmer's barn burned down, the neighbors would pitch in to rebuild it. That's a mutual. Nexus works the same way. Members buy the NXM token and put it into a shared pool. If you want protection for your funds on a specific app, say Uniswap, you pay a premium to the pool. And if Uniswap gets hacked, you file a claim. But here's the twist. Who decides if the claim is valid? There is no claims adjuster in the suit. The members of the village vote. Holders of the token vote on whether your loss was real and whether it's covered. If they vote yes, you get paid. Now you might be thinking, wait, why would they vote to pay me? That's their money leaving the pool. And that's a great question. And they do it because if they don't pay valid claims, nobody would buy their insurance anymore, and the value of their token would go to zero. They're incentivized to be honest to keep the business alive. Nexus is the market leader, holding about 80% of all on-chain insurance capital as of 2023. They've paid out millions, including $5 million when a platform called Rary Capital was hacked. We'll get back to the insurance crash test in a second, but first, a quick spotlight on the ecosystem powering this show, BMX. You see, a lot of dexes try to trap you. They force your trade through their own pools just to collect a fee, even if you don't get the best price. Deli Swap takes the opposite approach. It's a meta aggregator. It scans every single route on the base ecosystem for you. If another DEX has a better price, Deli Swap routes your trade through that DEX automatically, even if it means forfeiting the fee. It's not about protocol profit. It's about getting you the best execution every time. And for liquidity providers, it's even smarter. Instead of pairing with a naked token, you pair with WBLT. That means your liquidity is instantly backed by Bitcoin, Ethereum, and USDC, and you earn fees from the entire ecosystem. Swaps, NFTs, perps, intents, all in one position. One position, 3 blue chips, and several ways to earn. So stop guessing which DEX has the best price, because the Deli is open. Head over to Deli Swap to see how liquidity should work. And now, back to the episode. Part 3. The robot insurance. So, the village co-op model works, but some people argue it has a flaw. Human voting is slow, and sometimes humans are biased. So what if we could remove the humans entirely? And this leads to the next evolution. Parametric insurance. This is what platforms like Risk Harbor and Finance pioneered. Think of this like flight delay insurance. If your flight is more than 4 hours late, you don't need to argue with the agent. The computer sees the flight's time, sees it's late, and automatically deposits money into your account. Risk Harbor does this for crypto. They build policies with automated triggers. For example, if a smart contract loses 50% of its money in 1 minute, that is a hack. Pay the user immediately. Because there's no voting and no humans involved, a user could, in theory, get a payout in roughly 45 seconds or 1 Ethereum block of that hack occurring. This is the robotic future of insurance. Fast, unbiased, and completely based on code. Part 4. The protocol's own safety net. But wait, what if you don't have to buy a separate policy? Shouldn't the platform itself have some protection? This is where safety modules come in. And think of a safety module like a protocol's emergency piggy bank. The protocol captures a portion of fees it generates and saves them. And if something were to go wrong, like a hack or bad debt, it breaks the piggy bank to pay users back. Protocols like Aave pioneered this. But historically, there was a huge flaw. Most protocols kept this emergency fund in their own native token. So imagine if the Titanic's lifeboats were made out of the same ice that hit the ship. If the protocol gets hacked, the price of its token usually goes down. That means, right when you need money most, the emergency piggy bank practically loses most or all of its value. Here at BMX, specifically on Deli Swap, our decentralized exchange, we fixed this. BMX built a safety module, but with a critical twist. It doesn't hold volatile BMX tokens. Instead, it holds what's called stable LP positions, like USDC, USDT on Uniswap. And this basically means if there's ever a crisis, the backstop is rock solid. It holds its value even if the market is panicking. Part 5. The real-world test. Now having all these theories, mutuals, automations, safety modules, it's great, but do they actually work when a disaster strikes? In May of 2022, we got the answer during the collapse of Terra USD, also known as UST. And for those who weren't there, UST was a stablecoin. It was designed to always be worth exactly $1. Some people put their life savings into this, trusting that 1 UST will always equal $1. But in May, the peg broke. The value of 1 UST dropped to 80 cents, then 50 cents, then basically zero. This is called a Depeg. This was the moment of truth. A protocol called insured ACE, which operates a bit like a marketplace for different risks, had sold Depeg cover to many users. While the market was panicking, insured ACE confirmed a $12 million payout pool. They processed roughly 170 claims and paid out nearly $12 million to people who lost their savings. It was the largest single event payout in crypto history, and it proved that these systems aren't just toys. When the worst happens, the code worked, and people got their money back. Part 6. The suits enter the chat. There's a new player entering the arena. The old guard, the traditional insurance giants. We're seeing massive institutions like Lloyd's of London, an insurance marketplace that's been around for 300 years, start to underwrite crypto risks. They realize that institutional investors, the hedge funds and the pension funds, don't trust a village co-op or a robot with hundreds of millions of dollars. They want a legal contract signed. by a regulated company. Companies like Evertas and CoinCover are bridging this gap. CoinCover, for example, acts like a warranty for your crypto wallet. They monitor your wallet for suspicious activity, and if your private key gets stolen, their insurance policy, backed by Lloyd's, pays you back. It's a hybrid model. You get the tech of crypto, but the legal safety net of the traditional world. So, what does the future look like? Remember, 99% of funds are unprotected, but we're seeing a convergence. We have the Nexus mutuals for the crypto natives who want a community-run safety net. We have Risk Harbor for those who want the speed and automation. We have robust safety modules like BMX's safety module for Deli Swap for built-in protocol protection. And we have Lloyd's and Evertas for the institutions who need regulated contracts. We're slowly building the insurance layer of the internet. And as this layer grows, it makes the entire ecosystem safer. It turns that sports car driving at 200 miles an hour with no driver protection into a reliable vehicle that actually has airbags. Thank you for watching this episode of Unwrapped. If you found this helpful, hit the like button, make sure to subscribe. Check out the playlist on our YouTube channel, where you can find other deep dives, educational videos, and interviews with crypto's top builders. Stay safe out there, and I'll catch you on the next one.